Hello, we're Wheelie Good Bikes. I'm Corbin Bernier, the VP of Sales and Analytics.
I'm Ashlyn Devaney. I'm the VP of Marketing.
I'm Paige Marshall, the VP of Manufacturing.
I'm Alana Laidlaw. I'm the VP of Human Resources and Accounting.
I'm Mitchell Thunwait, CEO of Wheelie Good Bikes.
So for our financial ratios in Q5, we fell below average in pretty well every area. The one area that we did well in was our gross profit margin, where we were actually the highest. And then once again, fell below average for everything else. But we were not the lowest, so at least there's that. You can see here on the right on that chart, so our gross profit was just over $2 million. Our operating profits were negative $875,000. Our income before taxes was negative $860,000. Our earnings per share were at negative 17. Next slide. So Q6 was vastly different. We actually had the highest fixed assets turnover. We were above average in our total assets turnover. We had the highest gross profit margin, the highest net profit, highest return on assets, as well as a highest return on paid-in capital. We were above average in revenues as well as in gross profit, and we had the highest net income. So over here to the chart on the right, you can see our revenues were over $7 million. Our gross profits were over $4 million. We spent $174,408 on research and development. So that was investing essentially in our future. Our total expenses hit about 1.3 million, and our operating profits jumped drastically to over $3 million. This had our net income at $2.5 million, and a huge jump here. Our earnings per share from that negative 17 in Q5 jumped to 51. And on to Corbin.
So for the market share in Q5, when we entered Q6, we were tied for the lowest overall average market share at 11% alongside Next Ride. Next slide, please. But after the changes we made, going into Q7, we had the second highest overall market share at 23%, just behind Urban Pedals. I'll pass it to Ashlyn.
Awesome. So I'm going to go a quick overview of Q5 and Q6 for marketing. So for Q5, we had a lot planned. We had a release of a new bike. We increased prices. We've created new ads and then furthered our R&D research, buying specifically for Q6. Our new brand performed well, not as well as we were expecting, just because there's some miscommunication that had happened. Our new ad did not perform to what we expected, as that miscommunication caused us to only have the brand name on the advertisement. We fixed that very quickly in the next quarter. So in Q6, we revamped original brands, and we also updated our old ads. So the brand performance increased drastically alongside the performance of our ads, which included the one that got messed up a little bit, which is A-okay. We also ended up increasing our budget for our social media market, and we also just increased price for all of our brands as they were all updated with new R&D, which would be the superior carbon fiber body. So as I was going through some of their bigger events is the R&D research alongside the develop a new bike. The ad incident obviously would be a big moment, as that's when we realized something had happened and it got messed up. So all of that had happened. Our overall performance between the two quarters, I'm really happy with the change that happened. We went from our marketing effectiveness being one of our lower strengths to our top strength. So it became our number one strength, which is amazing to see. Some takeaways we do have here include double checking work. So I should have double checked the ad to make sure everything was in line. Expanded horizon sooner. We should have added more brands in sooner, as everyone else already had 4, 5, 6 bikes on on the market within 2 to 3 quarters. And also reverse engineering, we didn't start until late. So that is something we really drilled down into the last few quarters. And if you look at the brand judgment and price judgment for Q5, there's no Hard Rider. We got rid of it for Q5 just to see how our Hard Rider Pro would do. It did well as a brand. The ad didn't do well, but overall, I'm really happy with how everything had went. And I think I'm just going to hand it over to Corbin to talk about sales there.
So originally, with both our pitch and our results from Q5, we had disappointing results and a modest projection of 2,739 units, which was to keep in line with a stable, continuous growth of demand. Our aim was originally to reach the end of Q6 with a gross profit of at least 2 million and a net income of at least 1 million. However, because of brand improvements and hiring more staff members for the online market, we did see an incredible near tripling of demand and double the sales from Q5 to Q6. So we had our first profitable quarter with a gross profit, as Alana said, of 4.3 million and a net income of 2.5 million, which far exceeded our goals. The sudden spike in demand did cause us to lose 1,500 potential sales, likely as a result of overstaffing some of the locations and underestimating the draw of our new brand features. Having no fourth brand hurt the bottom line as well, as we didn't have a more price-sensitive bike. And we also chose to focus on the mountain bike segment over speed bikes, despite speed bikes still being our most profitable brand. Overall, I feel predicting demand was a challenging prospect for quarters with heavy fluctuations. Sales from the test quarter drove me to make some reserve predictions, and it led to some of our lost sales. In the future, I would use more information from other company performances like we did in Q6, so that I can predict how we could see demand rising through improvements to our products. And I'll pass it over to Alana.
All right, so looking at human resources, our initial plan, we put a high priority on salary. That had been, at the time, the most important factor to workers. Unfortunately, that plan kind of backfired. It didn't bring enough worker satisfaction. Going into Q3, our satisfaction rating was at a 69% for the sales force and a 71.1% satisfaction. So I wanted to raise that up. I decided that I wanted our goal to be at 80 to 85% employee satisfaction. So I switched around and made it a more well-rounded compensation plan, putting more focus on not only the salary, but I raised the health coverage to full coverage, raised the vacation to 4 weeks for the sales force, as well as 7% pension percentage. And that wound up raising our sales force satisfaction to 88.3, which was actually above the goal that I had set. And for production, I had raised them up to a $19,000 salary. Once again, full health benefits, 3 weeks vacation time, and a 7% pension percentage. And that actually brought their satisfaction up to 94.1, which was almost 10% higher than what the actual goal was. So we didn't necessarily rate first in that, but with how far over the goals, I'm super happy with that. I don't think I would actually even want the satisfaction to be higher than that. So with that said, I'm going to pass it on to Paige.
So for our manufacturing, going into Q6, we assumed our operating capacity would be set at around 50, increasing it from Q5, which would allow us to produce up to 3,250 units per quarter. We also maintained our fixed capacity at 8 printers and limited our overtime to 2 hours per day. While discussing Q6, we decided to raise our operating capacity to 60, which would produce 3,900 units per quarter, and our printer count stayed the same, as well as our overtime hours. The results from Q6 were not what we were expecting. Even with the increase in operating capacity and full use of our overtime allowance, we still had big stockouts across multiple bike models. Our manufacturing system just couldn't keep up with this large spike in demand. Our original plan was to gradually expand capacity to match the rising demand without overcommitting too early. However, I think that we underestimated just how quickly the demand would rise, especially in quarter 6. We followed more of a ramp up kind of a strategy, which led to stockouts in both quarter 3 and quarter 6, and this caused us to miss out on revenue opportunities when the demand exceeded what we expected. For quarter 6, you can see in the chart that we lost over 1,500 sales due to our limited capacity, especially in our higher demand models like the Fast Rider Pro and the Hard Rider Plus, who accounted for nearly 1,200 of those lost sales combined. This shows that while our demand grew quite quickly over the production, it couldn't keep up due to the lack of the resources that we had. And overall, I think we should have taken a chance and believed in our products and gave ourselves a higher fixed capacity to be able to sell more bikes. So off to Atlanta with the financials.
So our initial plan overview, going back once again to kind of like the Q2, Q3, our main goal was to set ourselves up for success with our future quarters. So at that time, we had just invested in Amsterdam. We bought more printers. We wanted to start investing in like market research and in manufacturing. And we really started putting money into our certificate of deposit just to ensure that financial cushion, keeping cash aside as well. Overall, our strategy has remained essentially the same. Leaving Q5, we did withdraw 600,000 from our certificate of deposit just to make up for some losses that happened then. But we continue to place a high focus on R&D research and a huge focus on licensing with other companies. Again, modest spending where possible and just keeping up with investing in the future. I think a big lesson for us, though, was that maybe we didn't take enough risks early in the beginning. I know Ashlyn has spoken a bit about maybe we should have invested in more bikes. Maybe we could have invested in more printers or opened up more stores a little bit quicker. But overall, where we ended up in Q6 is amazing, I think. So I'm pretty happy with how we've done. So I'm going to pass it on to Mitchell.
For our current position in the market, we currently have a 23% overall market share. It's number 2. We literally doubled our market share from Q5. It was 11% to 23%. We're leading the market share for mountain bikes, and we're number 2 for speed bikes. We're also the only company with the superior carbon material. We also have other R&D items that we have licensed, but are pretty niche in the market. And we also have a strong financial position. We turned a profit for the first time in Q6, and we have 3.8 million liquid cash. So our weaknesses, the recreation brand has been struggling, has improved with some of the changes that my team has mentioned, but we're still kind of struggling with our recreation brand and something we would like to improve upon. And like again was mentioned, just a number of brands in general, we want to have a variety of options for a variety of consumers. But again, we literally doubled our market share. So overall, I think we made some smart decisions. Next slide, please. So we're leading many areas against our competition. Like Ashlyn mentioned, we have the number 1 marketing effectiveness, and we're number 2 in a variety of other areas. And you can see on this graph here, we kind of stagnated, to be honest, for a couple quarters as we had some growing pains, but we revamped our lineup with the new R&D, and we actually have all 3 of our brands are the top rated brands, and all 3 of our brands are also the top rated ads. Next slide, please. So what's next for Wheelie Good Bikes? We've been investing in R&D pretty heavily to give ourselves a competitive edge, and we're going to continue to do so. Like I mentioned, the recreation brand is struggling. We're going to give it a revamp, maybe add a budget model, explore some other features, see what we can do to bring new life to the Easy Rider. We're going to keep making smart moves to gain market share and keep selling our Wheelie Good bikes. And just the last slide there. Thank you for your time. It's been our board of directors meeting.